First of all, why is the market lagging? I mean, I'm gonna tell you right now, the biggest answer to that lag right now that we're seeing is that there's a lack of liquidity or flows into the banking sector, into markets in general, money market funds. You could say bond markets, currency markets, equity markets, whatever. There's a lack of collateral, lack of liquidity. It's being removed. And this chart really tells us how that's happening. This is the US Treasury General Account on the top. On the bottom, we have global liquidity on a year over year basis. So it just measures all the money flows, collateral from central banks, um, from the US Treasury at least, and is there an increase or decrease in when the cycle changes. So it's year over year. So we're measuring on a momentum basis. If there's liquidity, you can see liquidity is falling right now. Okay. So it's hard for markets to keep up when there's a lack of that fuel in the market. We want to see that fuel going higher. Are we at the bottom? I don't know. So this is the Treasury General Account. The US Treasury has an account, and I have it inverted for some of you who already have seen it before. It's inverted because I wanted to highlight that when the chart goes up or when the US is injecting liquidity, the US Treasury is injecting liquidity in green, they're spending a bunch of borrowed money, a bunch of debt that they borrowed from the market. They're spending it into the economy some way or another. Okay. And when we have these upside moves, right, then liquidity is, it's called fiscal. I call it fiscal liquidity is coming into the market. It's coming into the economy. So markets go higher, right? There's more spending, stuff happens. And when that account goes down, right, when they're building it up, right now they're building it up, there's a lack of liquidity and it kind of stalls, not everybody, but it does stall things out. So right now they're building, and this is basically money that has to be paid to the not to be paid, but the reserves or the deposits. They're all moved to the US Treasury from the banking sector, less collateral, less deposits, less lending. There's all kinds of, you know, witchcraft going on in the financial system. All we really want to know is liquidity rising or not? And liquidity is falling. Okay. But we might be at the bottom. You can see there's not like a support, it's not a stock, but typically once I think we're at a trillion, once you get near a trillion, this is inverted, 1T right here, right? Once you get near a trillion, that's when they start to spend. Okay. This is the pandemic. That's a blip. You don't really want to look at that. But last time we got to around 800 billion, 800 billion, 900 billion. Now we're actually exceeding that. We're around 950 billion dollars that have built up from borrowed money from debt, and interest rates aren't really surging either. So this is actually a good setup, but there's a lack of liquidity. Where's it going to come from? Okay. And that's really the answer. The other part is that's fiscal liquidity from the US Treasury. The Fed is also lagging when it comes to liquidity. They've been tight for a while. So this is US Fed. Well, first, the blue is always going to be the global money supply. Okay. So this is all the liquidity in the world globally. Is it growing up or is it coming down? So it's been in a uptrend for the last 5 years, and it kind of broke out back in late 2024, and markets surged. We had a breakout, and now it's kind of slowing, and the path is still higher. That's the trick here. The path is still higher. We're just on pause. That's it. We're just on pause. And the Fed is actually reducing that liquidity, but they're going to start flipping maybe in 2026 where they start injecting. They haven't injected liquidity since, well, structurally, they haven't really injected since 2021, right? This is the last time they actually injected. This was just a banking crisis that they had to inject liquidity. So we're going to flip here. You should stay bullish if you're thinking long term. There isn't a crisis happening. You're not going to get a real broad-based recession just because of trade tariffs and all this. There's too much positive flows going into the market, and right now those flows are on pause. All right. So if we look at Japan, and this is just global liquidity in general, Japan is actually draining liquidity. They're tightening rates. I believe they're going to increase rates. So that's a drag on the global economy, mostly for Bitcoin, for US tech. Yeah, because other countries, right? Wealthy people in other countries, they want to own US tech. So Japan's lagging. England, right? The Bank of England, lagging liquidity, right? So they're all dragging on this global flow that bids up, risk assets in general. If you take the not top five central banks, so you have China, US, Japan, China, US, Japan, the Bank of England, and the European Central Bank. Outside of that, liquidity is actually rising. So the rest of the world's actually injecting liquidity, and that's one positive flow or one factor that takes us higher. China, the second biggest economy, is increasing liquidity, right? So China is still pumping like crazy. I'm not too worried about this market here.